So she didn't inherit Grandpa's jawline, but there's no doubt she's family. It's your job to raise her, and it can be tough. Let's make it easier. With technology and automation, you can do more, like produce high-quality bales with way less effort. Built-in sensors can measure bale moisture and size, so you can monitor quality on the go and manage your fleet from your phone. Sit back and enjoy effortless operation. Discover an easier way to work.
Welcome back once again as Market Talk continues. I'm Susan Littlefield, of course, sitting in for Jesse Allen, and Market Talk is being powered by the great folks over at John Deere. So chasing headlines, I think, unfortunately, Mike, this has been something we've been talking about for quite some time. And I should say Mike Zuzolo joins us with Global Commodity Analytics. Better give you that formal announcement there, Mike. So let's talk about this headline chasing that the markets have had with the weakness within today's trade action.
Yeah, it's kind of unavoidable to have to talk about it, Susan, because it is moving the prices, and they're pretty big headlines. They are, headlines that actually have to do with supply demand fundamentals. And the biggest headline this week, other than the weather drying out and not being as wet for the row crops in the primary corn and bean belt versus when we went home last week, is, I think, clearly what the Argentinians decided to do early in the week, and that is try and drum up $7 billion worth of US dollar hard currencies. And instead of going into the currency markets and doing that and causing more inflation and more fear by the investors around the world, they decided to throw out their export taxes on soy, corn, and wheat. Soy obviously going to be the big player because that's what they have the most of to export. And the result of that, as we hit midweek stride here in the trade, was we went from about 10 cargoes of Chinese purchases of Argentine beans to then by Wednesday morning, the trade was talking 20 cargoes. Now, depending upon what size of cargo that's going to be, you're talking about 1 to 1.3 million metric tons of soybeans that we have once again lost the demand on, the export demand on. And this, I think, opens up the door to a bigger narrative that if we don't get anything done with China, we're essentially losing 9.5 million metric tons of soybean demand each and every month from here on out. And the trade's going to have to think about that more and more as we get into the fourth quarter, which is just next week.
Well, you talk of those headline chasers. I mean, USDA talked about, not USDA, but Argentina with the bailout coming from the United States, which does have an effect within the USDA too. But they're saying, get rid of the tax holiday and we'll help you out.
Yes, and I think that was very necessary because, we are struggling here with basis levels in the Western Corn Belt nearing a 160 under in North Dakota, and then that just trickles down all the way into Kansas and Oklahoma. We here in northeastern Kansas, last time I checked a couple of days ago, we're still around 80 under in the soybeans. And so, we're getting hit probably 20 to 50 cents worse than we normally would in terms of our part of the country. North Dakota is probably getting hit almost $1 more than what they would be for being able to sell beans for October delivery. And it's interesting because, Susan, when you look at the export inspections from Monday, we're still running 26% above last year. And that's because I think in part the trade has picked up some extra demand from other countries, but that extra demand has come because of the US dollar weakness. And so if there's one thing that I feel like I did a good job on this year with the marketing side was pressuring more sales of beans because I expected the corn and the wheat to hold up better than the soybeans because of the China-US relationship if we had a weaker dollar. And I think this is where, for this week's market talk discussion, how do we weave together what you and I are talking about with Argentina and China with the idea that I still have that we're still running about parallel with 2024 this time last year, except we are starting to see some differences between corn and beans.
All right. Since you brought it up, let me pull up this chart of yours as we look at a bit of a spread between the corn and the beans.
Yeah, Deece July spread in corn, Nove July spread in soybeans really shows that basis problem in the soybeans compared to the corn. also shows that, yes, while we're up about 26% on soybean exports year to date, we're up 59% in the corn. And so the spread is really starting to get up there. The July corn spread is now back to levels not seen since June, July of last year. And so I would still say we have razor thin stocks, and producers have no desire to sell corn unless they're in those areas of the Pacific Northwest basin, so to speak, like the Dakotas, where they're going to be forced to store more beans because their basis is so bad. They'll let more corn go probably in order to make more room for the beans. This is dependent upon the idea that you have a big crop. I will say real briefly, I think this spread also kind of suggests to me at this stage of harvest, Susan, what I'm picking up from producers, the client producers I work with, it's too early to know about bean yields yet. But in the corn, it's pretty solid right now that I'm getting pretty strong evidence of contacts telling me 10 to 30 bushels less than last year in states like Indiana, Illinois, Missouri, Nebraska. Dryland Nebraska better this year, but irrigated well under last year. And then we have that question mark about the disease pressure. And I think this basis for Iowa, Minnesota, and Nebraska, those three states especially, probably more disease pressure than what we thought that we'd have 2 months ago. And I think the spread's starting to show that up as well.
So let's look at the bean corn ratio and get your takeaway of what we're seeing on the screen.
Yeah, so that was the good news with the corn rallying. The bad news, unless the wheat can really pick it up here, the bad news is that this spread or this ratio, the corn divided by the beans at 2.35, 2.33 area, the corn is the most premium to the beans now, or the beans are the most discount to the corn since June of last year, July of last year. And what this means to me is that corn can't keep going it alone. And I actually think that's what we ran into on Wednesday's trade, was we didn't have help from either the wheat or the beans. I think corn needs one or the other to be able to continue that pathway to the upside, heading into a higher move as we get into the 1st of October, like we did last year at this time. There's no question in my mind that as I look back on the 24 September time period, 24 August time period, beans were a necessary component to the rally that we had back then. They're even more so this year because of this China-Argentine news.
Which I think really brings in our next slide, talking about these November seasonals for soybeans.
Yeah, and this is the part of the talk I really don't enjoy at all, because you can see by this chart, with the red being this year's November beans, green being last year's November beans, not only are we almost identical in price trend, we're actually identical in price. And we are at that point now where we need to go higher, and higher by about 30, 40 cents. That's what we pretty much did last year at this time, and heading into the end of Sep, early October. What we don't want to see is the market start to think once again about 2018 and the last time we went through a lot of tariff and export demand issues with China. That's when we were striking $8, $9 beans. And that is a fear of mine at this point, Susan. It's not a high likelihood. I would rate it no better than 50-50 at this point. But if we would see the dollar gain against the Brazilian currency, because the Brazilian currency is at like a 12 to 14 month high right now against the dollar, and that's what's making us so competitive with Brazil, even with the tariffs. But if we would see that dollar start to go higher, say because President Trump in his UN speech made the world think, wow, we're probably going to have a major conflict in this world, and Russia is no longer going to be given a pass at this stage by NATO, we could see the dollar being bought as a safe haven. So I just want to get out there ahead of this and in front of this in case this market decides to take that route.
You know, and it's interesting how these headlines are just, continuing to grapple with what we see. And especially that conversation I've seen through social media just in the last couple of days of what type of threat Brazil is going to continue to bring. And when I use a threat, I mean because of the export side of it and what worrisomes we might have as U.S. growers.
It's going to be big. And they've been working about a decade with China on this moment. And that's what, you don't understand if you haven't been keeping track of this. I really do feel like that's what kind of separates my analysis and research from a lot of my colleagues. The Shanque port in Peru, the intercontinental railroad that Brazil is building with Peru's help and with China's money to get a railroad from east to west so they can tap into other parts of Brazilian soybean areas and other commodities out of Brazil and even other countries like Argentina. This is why you talked about the bailout, if you will, of Argentina and the swap line that the Treasury Secretary offered. That $20 billion comes at a price, and that is, don't buddy up to China like your next door neighbor Brazil did. China's definitely got us on the defensive in Latin America, and that's because they've been working about a decade on this moment. And so that is another key element to the dollar. And I would say the last thing to the dollar that maybe needs to be mentioned is the Federal Reserve Chairman gave a very strange, in my opinion, strange speech or conversation just on Tuesday. And, he talked about the idea that don't be, assured that we're going to be doing all these rate cuts like you've built into the market. That too could, stimulate the dollar in terms of the upside. That I think came as quite a surprise.
And I'm really surprised that those comments that he made to that group hasn't resurfaced more today in the trade action.
You're right. And what happens typically with the algorithmic trading that I've come to find out, Susan, is it takes time, just like it does the human beings, time to work through all the news. And so it's not as high a priority as some of these other things would be my guess. But I do think it's a very big potential market mover in that the dollar could be seen as a buy again.
The other headline that seems to be making waves today is the fact that USDA said they could be opening, and I use the word could, be opening that border with Mexico as early as November. And considering that we're 70 miles from the border that this screwworm was found, should the market be nervous from a cattle perspective? And is that the reason why we saw the drop within the trade today?
Yeah, this puts me in a pretty tough predicament because I looked and looked and looked to see where USDA actually matched up with the president of Mexico, Sheinbaum's press conference that she had. And she was talking about both the USDA having a report that's under review. She has talked about it being accelerated. I think USDA has also talked about it being accelerated. But the last I saw, Susan, was that Sheinbaum had said that USDA is ahead of schedule in terms of opening the border, but I never saw much come from Washington. But regardless, if it did, that does really open up the idea that the cycles and the seasonals and the fact that we're coming into the fourth quarter, this is really the time to think about hedging and getting floors underneath you if you haven't yet, because of the fact that that Mexican situation has definitely fed the bull in the feeder cattle market, especially. Thank goodness we had 10% lower placements on the cattle and feed report, or we probably could be down even more. But, there's some charts that we're going to look at here that are going to suggest this is a good time to really consider hedging.
So let's pull up your first chart as we look at the cash comparison.
Yeah, this is a great chart because you don't need to care too much about the fundamentals in the market right now. What you're really looking at is the negotiated cash steer price, which is in white, versus the bar chart, which is lead month cattle futures, live cattle. And you see this really nice channel that we've built up since 2020. As we've shrunk the herd, the live cattle have been fed by the feeder cattle to the upside, and they've developed a very nice, tight trading range channel, upward trending channel. We went above, and so we went parabolic. We priced in the screwworm and we also, those last couple months, I think priced in the Brazilian beef tariffs that really are going to slow the beef imports down coming into this country. That's priced in. We're probably working into rationing some demand. And so now this week, we're coming back to the top end of that trading channel. So this is the chart I show the cattle producers that I work with that say this year is different than 2014, 2015. We're going to stick with the demand. We have a lot tighter supply. All true because of the competing meats out there and because of what we're dealing with in terms of heifers. But if you look at this channel, you could go all the way back to the bottom of the channel around $200 currently. that price break from where we're at right now at about 234 is about a 15% price break. So these are the kind of corrections, even if we stay in the uptrend and keep the channel intact, that's still very worthy of going after, if you ask me.
So then where are we sitting when it comes to the feeder side of everything?
Yeah, now this is one of the things that I like to show those same cattlemen and cattle ladies when it comes to the cyclical nature of the feeder cattle market. And yes, it's going to take 3+ years to rebuild the herd, maybe longer this time around because of the Mexican feeders not coming across the border. That's all an open question mark right now. But what we do notice is going all the way back into the early 2000s, late 1990s, there's a very strong 7-year cycle. And every year is different. I have to say that for the compliance people, but between the supply side, the demand side, and the cycle side, I still think this is a very good cycle to be using. And if you match this cycle in orange and it's starting to curl down now after 4+ years of going higher, you also have 3 big trend lines in the feeder cattle market. I would say and suggest that if you take that yellow trend line out, you're confirming the likelihood of a high likelihood of going back to the white trend line. That's about 320. So you're talking about going from 365 to 320. Again, very worthy of getting hedges in place for. If you would take the white trend line out, that would suggest to me that the cycle is appropriate and accurate. And you're probably going to have to go all the way back down to the major trend line that's in purple. Again, very worthwhile hedging. And so I do think we're rationing demand. I am nervous about Wall Street having a major correction in the fourth quarter. And so starting the end of this week, I will start recommending getting some Q4 hedges in place.
So then I wanted to bring up the fact, I'm going to pull this chart up while we're talking about it because headlines, again, back to headlines, that the secretary had said might be some sort of incentives out there for the heifer retention. So that kind of brought up what you and I were talking about early this week when we chatted is what does all this mean when it comes to heifer retention?
Yeah, this is a great question because look, we've got a situation where the Mexican border being closed has clearly skewed this market, and it's probably even skewed us in terms of heifer prices being at the same price or even higher in the South, like Oklahoma. You can get 4 or 5 weight heifers are as high, if not higher, than steers are right now. And so I think it's likely, and I've been told by some of my cow calf guys in Mississippi that they are working their heifers, buying heifers now to be able to, retain and grow their herd back. And so it really would, if USDA would make a move like that, it would probably assure us of a bigger domestic beef supply down the road. But if they didn't at the same time open the Mexican border back up, you would tighten the supplies even more, worsening the prices at the wholesale level and obviously at the retail level. And beef inflation, meat inflation overall would be also very high. This comes in the midst of another big cull of turkeys in South Dakota in a commercial flock because of that HPAI coming around again because of the bird migration, the wild bird migration. And we have that hogs and pigs report that's coming out Thursday, probably going to suggest we aren't really building the herd at all there. And so you got a situation where I like hedging. I like the known cost hedging right now because of exactly these things. But if you look at that chart in detail, and I'm going to talk more about this with
Here, I'll
clients.
pull it back up.
Oh, sure. If you look at the chart in more detail with the last 3 years of the heifers, it's a real big distinction on the heifer side versus the beef cow side. You notice that in the red, you've got the beef cow inventory number. That number is not that much lower than it was back during our last cycle of back in 2014 of about 29 million head. It's really the heifer side of the equation that we've really cut back a lot. So I feel like that between the beef cow and the heifer, the numbers are going to be ample enough that it doesn't justify being above USDA's average price of 249. In other words, what I'm saying is that last WASDE report they put out, I think that's the top end for the live cattle steer price for 2026, unless we get another brand new fundamental that we can't see yet.
Well, there's so many things that are going to be weighing in just over the next couple of weeks that, we're trying to get harvest done. We're looking at borders opening, not opening, tensions continue with tariffs. It makes it interesting and difficult at the same time, I guess, Mike, for that producer, that grower to say, okay, this is where I need to be thinking about my marketing plan instead of kind of flying by the seat of their pants.
Yeah, it is. And between the cash basis for the corn and beans, especially the soybeans, depending on what side of the corn belt you're on, and given what we talked about in the cattle side of the equation, Susan, I really think it goes back to keep things, directly related to your profit and loss. Your P&L is really what matters at the end of the day. And if you can go out and hedge April fat cattle right now at the end of this week and squeeze out a profit, either by doing hedges or by doing livestock revenue insurance, I think it's a really good idea to take a look at that. I've got as many cattlemen and women right now telling me they want to buy back into the market when they think we've had a correction because they already have livestock revenue insurance on. So you just got to stay engaged in this market. And that's really difficult given what we're talking about here, just what we've gone through in these last few minutes. It's almost overwhelming, but we can't let it be so. We just got to keep focused on our P&L.
Very well put. Thanks, Mike, for joining us today.
Thank you, Susan. Great to be with you.
That's Mike Zuzolo, Mike with Global Commodity Analytics. A quick reminder that commodity futures and options do involve a substantial risk of loss, not suitable to all investors. Market Talk is being powered by the folks over at John Deere. Data-driven farming means better decisions and more peace of mind. So where can you get that data? The John Deere Operations Center. It actually gives you real-time data and insight that helps you run your farm better. And that is Market Talk.